For Wall Street Media, I'm Mike, I'm here with Doug, and we'll help you make money in the stock market with information you can't find anywhere else.
Hello, my friend, how you doing?
Good, good.
What a great day, we've got Rich Gordon.
Yes, we do. We have Rich Gordon, the highly regarded fixed income market strategist of Ecovia Corporation. He discussed the financial sector as a catalyst for the rise of the S&P over the last 5 trading days. It surged 23% during that period, and several banks suggested profitability last week.
Love Rich Gordon. Rich Gordon, smart, ethical, and I want to make this pay-per-view, but German doesn't agree yet.
It will stay free. Let's take a look at the clip.
Hi, and welcome again to Market Summary Online. Over the past 5 trading days, the stock market has finally firmed, and the S&P is now up over 11% from its recent lows. The catalyst for the rally has been the financial sector, which surged 23% during that period. Last week, several large banks suggested that they had been profitable during the first 2 months of the year. This is significant because if, even after bolstering their bad debt reserves, they aren't going to incur further net losses, it's reasonable to expect that their current capital levels are adequate. Financials got a further boost this week from the FASB, which proposed allowing companies to use significant judgment in valuing certain balance sheet assets, which would reduce the negative impact that mark-to-market accounting has had on financials during this downturn. Without getting into a lengthy discussion of the pros and cons of mark-to-market accounting, I think that in this downturn, it put a lot of stress on leveraged financial entities and significantly contributed to the rapid deleveraging of the financial system and overall price and wealth destruction in financial assets. The theory of mark-to-market accounting presupposes that there's actually a market, a set of both buyers and sellers willing to engage in arm's-length transactions. Without these elements, the use of mark-to-market accounting in a liquidity vacuum could only result in severe distortions, and we believe investors are glad to see that the rules are being revised. Turning to interest rates and liquid products, the increase in risk appetite gave investors reason to sell treasuries, and the 10-year yield has now increased by 10 basis points since last week. With heavy supply coming throughout this year, we continue to believe that long treasuries should be sold into any strength and net duration shortened in order to position portfolios for a higher yield environment later this year and next. The current short-term resistance level for the 10-year yield is 305. Through there, the next good support level is at 333. It's interesting to note that fixed income portfolio managers have been steadily lengthening their durations over the past 2 months and are now slightly long to their targeted benchmarks. They've generally been wrong, as the price of the 10-year is off more than 6 points so far this year. On the other hand, large speculators have been doing exactly the opposite, generally shorting the Treasury market since the beginning of the year. Without question, the sector that's benefiting the most from direct government support is the conventional MBS market. The spreads on current coupon mortgages have contracted by 115 basis points from the wides reached in November, and we think it's likely that the government continues to buy conventional mortgages throughout 2009, either through the Treasury Purchase Program or by growing the GSE retained mortgage portfolios. Turning now to credit and spread products, corporate bonds rallied last week along with most risk assets. High yield in particular turned in a strong performance, with prices up more than 9 points during that period. Even so, fixed income credit hasn't been able to keep pace with the powerful rally in stocks, which were up more than 11% during the same period. In contrast, parts of the securitized markets continue to struggle. CMBS in particular has been weak, with AAA dupers unable to get any traction. During the fourth quarter last year, unleveraged nominal yields that rose to 15% brought in buyers, and there's probably some sponsorship at those same levels, although that would imply another 100 basis points of spread widening from here. Home equity spreads are also lagging. 5-year AAA home equity is 125 basis points wider over the past 4 weeks. The uncertainty about how cram downs could potentially affect future cash flow is diminishing the value of fundamental analysis of the underlying pools of credit and keeping investors away. In commodities, OPEC elected to maintain production levels at their meeting instead of cutting them further. They think the global economy is still very fragile, and a sudden price increase might destabilize and derail any potential recovery later this year. The chart shows that they probably made the right decision. Oil prices have been firming up and trending steadily higher over the past month, despite the deepening economic recession in the U.S. The next key resistance level on WTI is around $49. Finally, in currencies, the U.S. dollar looks like it's peaked in this cycle. The chart shows that over the past 8 trading days, the dollar has lost 3.5% against the euro. There are several reasons why we think the tide may have turned against the dollar. First, further interest rate cuts and liquidity injections by the ECB are already factored into the forward interest rate pricing expectations. So even though the carry disadvantage of the dollar versus the euro will narrow, it's already accounted for. Second, the majority of the damage in this credit contraction was to the balance sheets of U.S. financials, so most of the stimulus to rectify the situation has come from the Fed and the U.S. Treasury. The long and the short of it is that while both the economies of the U.S. and the Eurozone are undergoing severe and probably long-lasting contractions, we've already printed a lot more of our own money than has the ECB, and will continue to do so. And that simple dynamic should cap any cyclical appreciation in the dollar, which I think we've already seen. The U.S. currency will also probably weaken against high-yielding currencies like the Mexican peso and the Australian dollar over the intermediate term as commodities prices firm.
Hey, see, you should be charged for that. You should be charged for that. Good stuff, man. Really good stuff. Perfect. I love him. Guys, Rich Gordon is the greatest, and you should listen to him. We'll have him again in 2 weeks.
We're here every day at Wall Street Media. You can find us directly at wsmco.com. Thanks.